Good morning, everyone, and thank you for joining us today for our next installment of our Building Blocks workshop. Today, our topic is Taxes Made Simple. We will discuss strategies, deductions, and credits. As you hop on, if you have not already, please put your name, your company name, and your city in the chat box. I would like to introduce myself. My name is Anna Ramirez. I am the Acting Policy and Supportive Services Unit Manager for the Office of Business and Workforce Diversity here at IDOT. I would also like to introduce the Deputy Director of the Office of Business and Workforce Diversity, Brian Hendricks. He is on the call today. And I would also like to introduce Melissa Hamilton with Synergetic Solutions, Inc. She is IDOT's Supportive Services Certification and Management Consultant for Districts 4 through 6.
Why, thank you, Anna. So thank you all who have joined our workshop today. We're going to go over just a few preliminary announcements. If you don't mind, mute yourself and keep your video off. If you have questions throughout the presentation, we'll be taking breaks to answer those questions. You can enter those in the chat or in the Q&A. This presentation is going to be recorded, so if you have specific questions that you don't want publicly shown, please private message myself, Melissa Hamilton, through the chat, and we'll make sure that we still answer your question while ensuring not to disclose who you are. But the recording or the presentation is going to be recorded. We will provide an email to you with the presentation, a copy of it, as well as access to the recording and all the additional helpful resources that we go over today. And then at the very end, we'll have a short survey that we ask that all of you take. It'll also be in that email follow-up, but we like to get feedback from our firms that are attending these workshops. Throughout each year, we offer building blocks from October through February, and during that time, we always want to make sure that we're providing relevant content to your firm and content that can support and help you. So that survey helps us to better develop, as well as helps us determine what additional training we can provide you through these workshop series throughout the year. And then just a disclaimer, this presentation is for informational purposes only. It's not intended to provide any accounting, legal, or tax, financial, or professional advice. It does not consider your individual and company circumstances or needs. So before acting on any of the information in this presentation, you're going to want to ensure that you reach out to a tax professional, attorney, or a professional to analyze and address your specific needs as it pertains to the content. Our agenda today, we've covered our introductions and our preliminary announcements. We're going to discuss IDOT's goals. I'll turn it over to our presenter today to talk about our topic, Taxes Made Simple, Strategies, Deductions, and Credits. Then we'll open up for Q&A, discuss what's next and how to stay connected with IDOT. And then depending on who our audience is for today, we will discuss the DBE supportive services, the interim final rule, and our closing remarks. So IDOT's goal is to provide assistance to DBE firms and individuals interested in doing business with the department in ways that ensures equity, access, and transparency. IDOT, in accordance with federal guidelines, strives to facilitate and implement programs that can help current and future business partners open the door to doing business with IDOT. Excuse me. We do this in a couple different ways. One is the resource centers that we have available, as well as our supportive services programs. And then we also have workshops and events that we host as well. And you guys are all attending one of those today. The programs that IDOT provides through supportive services is at no charge to firms. So it's very a wonderful program that allows you guys access to growth and development at no cost to you. Then we have opportunities for learning and growing with supportive services. As you know, being a DBE firm does not guarantee you a project or a contract or work. So it's very important to ensure that you're developing and growing your firm, and IDOT supports that by providing you technical and management assistance, helping you navigate your operational expenses through services, connecting with other firms that are DBE and prime contractors through our events and networking, and then also ensuring that you discover the best practices for successfully working with IDOT, ensuring you're aware of all policy changes and contract compliance. So, with that said, our workshop today, Manny Michelson, who is with TPH Strategies, he's also a sub-consultant with supportive services with IDOT. He will be leading our topic today. He is an enrolled agent with the IRS, as well he has an MBA also. So Manny is well versed in tax law, but again, as we mentioned, if you have specific scenarios or situations, you do want to check those out before proceeding with any of the information in this presentation. So at this point, I will turn it over to Manny Michelson and let him educate us today.
Hang on, such a fun.
Yep, I was going to say you're on mute. There you go.
Can you hear me now? Sorry.
Yes, you're all good.
Perfect. So sorry about that. Again, thanks, Melissa, and good morning, everyone. Thank you all for being here. My name is Manny Michelson, and I will be presenting on a fun topic today, taxes. So the goal of today's session is exactly what the title says, Taxes Made Simple. My goal today is essentially to take complex topics that often feel overwhelming or intimidating and break those down into some practical real-world concepts that you can actually apply to your individual businesses. So we're going to be covering three main areas today. First, we'll walk through the types of business taxes you're most likely to encounter. Then we'll look at some key tax forms, including how everything ultimately flows to your personal 1040 tax return. And finally, we'll talk about some self-employment basics, including how taxes work when you're responsible for paying them yourself. Now, you won't be a tax expert by the end of this session, but you will have a clearer understanding of how the pieces fit together and when it makes sense to ask better questions or seek professional guidance. So to understand how taxes affect your business, the first thing we need to do is separate out the different types of taxes, because there are several very different purposes and they're calculated very differently. So most business owners think of their tax bill as essentially one big number, but in reality, it's usually a combination of several taxes working at the same time. So that first one is going to be your income tax. So, and this applies at both the federal level and the state level. Your income tax is essentially based on your business profits, not your total revenue. So in simpler terms, that's essentially what's left after you subtract all your ordinary and necessary business expenses from what you've earned. And we'll see some examples of how that calculation flows down in the next couple of slides. At the federal level, your income, again, all flows down to your 1040. But at the state level, Illinois does apply a flat tax rate of 4.95%. So that means that everyone essentially is paying the same percentage regardless of their income, even though they're not paying the same tax amount. The next one here is self-employment tax. And so this is that tax for sole proprietors, partners, single member LLCs, and this one typically catches a lot of people off guard. If you're a sole proprietor or partner in a partnership, there is no employer withholding your Social Security and Medicare taxes for you, so you're responsible for both sides of that. So oftentimes what you'll hear is when you're self-employed, you wear two hats. You're essentially both the employee and the employer, and I'll dive into that in a little bit more detail in the next couple of slides here, but that's just very important to remember. Essentially, just think of it as you're covering the cost of being your own boss. Again, you're covering both the employee portion, even though that happens to be you, and the employer portion, which is your business portion of your Social Security and Medicare taxes. So the next one here is sales tax. And so sales tax is different because it's not necessarily a tax on your particular business. It's a tax on your customers that you're responsible for collecting and remitting. When applicable to your business in particular, you're essentially acting as a middleman for the state of Illinois. You collect the taxes at the point of sale, and you pass it along through the Illinois Department of Revenue. So sales tax rates typically do vary based on location, and not all products or services are taxable, which is why knowing whether your sales tax applies to your business is really crucial. A lot of times you'll see small businesses get in trouble with sales tax, and something sarcastically but true that I tell my clients is, if you wanted to charge $6.50 for a product, that should have been your price. If your price is $5 and the client pays $6.50, that $1.50 does not belong to you. It belongs to the Department of Revenue. And so that's just something to keep in mind. Even though that it will flow into your bank account, you're just collecting those sales taxes, and they must be paid to the state. And you don't want to get in trouble with that. Lastly is your payroll taxes, which apply essentially if you have employees. So these include your federal and state income tax withholdings, plus your Social Security and Medicare taxes that you withhold from employee paychecks, and then match as the employer. So again, if you're self-employed, you're paying both halves. Your employee half that's withheld from your paycheck, and the employer half of your FICA. So once you have payroll, I will add that your compliance requirements typically increase significantly. So accuracy and timeliness become extremely important when it comes to payroll taxes. So essentially, now that we've identified the main types of taxes that businesses deal with, I want to take a look further at one of the most important forms where all of this comes together, and that's your Form 1040. So this is your 1040, officially titled the U.S. Individual Income Tax Return. And I want you to think about this form in its entirety as the hub of your entire tax return. No matter how many businesses you own, how many side projects you have, or how many different income sources you earn, eventually it all lands right here. And what we'll do over the next couple of slides, essentially, I'm not trying to necessarily turn you into tax preparers, but instead I really want you to understand what this form is doing. So when you work with your accountant or you review your return, it actually makes more sense. Something I like to tell my clients personally is every time you leave my office, I want you to feel a little bit more confident and competent reading your return, because as you will see, most tax returns are typically just 6 pages, 2 to 3 pages for the federal on a 1040, and 2 to 3 pages on the state side. Everything else, as you'll see shortly, is supplemental information and just extra work for us accountants to do. So to kick things off, at the top of your 1040 is the basic but very important personal information section. And so this is where your name and your Social Security number go. And if you're married, your spouse's information goes underneath it. Next is your home address. Pretty self-explanatory here, city, town. You could put a P.O. box. And if you have a foreign address, the instructions are a little bit different, but that's not really common. Next is your filing status. And so one thing I want to emphasize is that your filing status is determined as of December 31st of the tax year. And so a very common example that they give us in tax school is if you're married on December 31st at 11:59 p.m., the IRS considers you married for the entire year. And so your filing status is very, very important because it impacts your tax brackets, your standard deduction, as we'll see shortly, and your eligibility for certain credits. You'll also see, though it's often ignored, this small checkbox related to the Presidential Election Campaign Fund. So checking this box will not impact your tax return. You're not going to get a higher or lower refund or higher or lower tax rate. It simply directs $3 of your federal funds, if you so choose, to the presidential election campaign. A little fun fact about this is this fund has been used by past presidents such as Obama, Biden, and current President Trump. You cannot pick which side those $3 goes to. It's just a general fund that candidates are allowed to pull from. So you'll notice a question near the top of your return asking about digital assets. This is relatively new in the last couple of years, but this question is related to things like cryptocurrencies, NFTs, or any other virtual type of currency. Not to be mistaken, though, this question isn't asking whether or not you own crypto. It's asking whether or not you received, sold, exchanged, or otherwise disposed of a digital asset at any point during the year. So if you were paid in crypto, if you sold crypto, or if you earned it through mining or staking, and yes, those are real crypto terms, the answer to this question is more likely yes, and it does need to be reported. So the IRS does pay really, really close attention to this question, so accuracy here is very, very important. There is, and this is a little bit too high level for this presentation, a new tax form that came out for fiscal year 2025 called the 1099-DA for digital assets. And as you'll learn through this presentation, there's not a lot of creativity in taxes, so most of the naming conventions are pretty standard for what the form actually covers. So that's just something to look out for if you have been trading or exchanging any cryptocurrencies on the market. This next section here is where you list your dependents. And so this includes your children or any other qualifying individuals that you support. Dependents can be can significantly impact your tax return because they may qualify for valuable credits. Common one like the child tax credit, which this year has increased to $2,200, and the credit for other dependents, so parents, in-laws, some of those things. It's also very important that your dependents are only claimed once, which is why coordination is especially important in shared custody or multi-family situations. Something that's very common is you'll have your child file their tax returns while they're in college, and they don't check the box that they're a dependent on someone else's return. And so when you file the parent's tax return, it oftentimes gets rejected. So you want to make sure you pay attention to this top section here and that all the information is being filled out accordingly. Otherwise, it can result in payment delays or refund delays, I should say, and then additional tax prep fees. Okay, so as we move further down the form, this is where the math really starts to happen. So this section here is essentially all of your income. So line 1A, as you see, is what will be reported on box 1 of your W-2. So this would be your gross wages. You can see in line C, or 1C, tip income that's not reported on your W-2, which is important, especially now with that new tip credit, but I'll show you where that goes in the next couple of slides. Any employer-provided adoption benefits that exceed the standard limit, any non-taxable combat pay. When you get down to number 2, you get down to more so investment income. So you have taxable interest and ordinary dividends, some of those things. And then 4, 5, and 6, you're dealing with more retirement income, IRA distributions, pensions and annuities, and your Social Security benefits. 7A and B is where you deal with capital gains or losses. But what we're primarily going to focus on is 8, which is here, additional income from Schedule 1. So remember what I said when I started this presentation, which is your tax return is typically about 2 or 3 pages, only referring to the federal slide. If you see there, it says additional income from Schedule 1. We'll dive into what the Schedule 1 is. Essentially, it's just a supportive documentation, what flows there and why does it flow to your Schedule 1 versus flowing here. We'll go over that. We essentially take all of your income from 1A to 8, and we add all that together, and that becomes your total income. Now, and we'll come back to this again, if you can see number 10, it says adjustments to income. So we can already see that the Schedule 1 has 2 things, additional income and adjustments to your income. And so we'll talk about that in the next couple of slides. So I want you guys to remember this $6,358 number and remember this $90,000 number, because we'll tie this all back in and I'll show you how this ebbs and flows. So again, with that calculation, we take all your income, we total it up, we take out any adjustments, and that's how we arrive at what's called your AGI, or your adjusted gross income. And that's that $83,000 number. So here now we're on the second half of your tax return. So this is the tax and the credits. So essentially line B is just your AGI repeated again, but from your AGI, we either deduct the standard deduction, which the figures are on the left-hand side of the screen there. So as we can see for this fictitious client, Mr. Blart, he is single, so his standard deduction is $15,750 for the 2025 tax year. If he itemized and his itemized deductions are higher than that standard deduction number, then we would put that itemized figure on the same line. Excuse me. If you're self-employed, you might also qualify for a special and an additional deduction called the QBID, or the Qualified Business Income Deduction. So that's what we can see in line 13A. Essentially what that is it allows practitioners and business owners or small business owners to deduct 20% of their qualified business income. And that's what you'll see on 13A there. And so these two figures get added up, and from those deductions, we arrive here at your taxable income. So it's this figure here that actually gets put into the tax table, and that's how we arrive at Paul's tax liability of $6,866. So I'm gonna take a step back, and I want to reiterate what I said one more time. We're taking all of your income, subtracting out any adjustments, we get your AGI. We then subtract out, if you're a business owner, QBI and the standard deduction, so you get both. And then from there, we get your taxable income. So on $90,000 of gross income, Paul's taxable income gets reduced after all those adjustments to only $54,000. And that is the number that he pays taxes on. He doesn't pay tax on the 90, he pays tax on the 68. But there is a caveat there we'll touch on in just one second. So after we calculate the tax liability, again, the $6,800, we can deduct credits. So things like the child tax credit will be seen in lines 19. And so you can see there, that's where we would enter any credits. Now, this is a good thing to note. We'll touch on this later. There is a difference between tax deductions, things that reduce your taxable income, and tax credits, things that reduce your tax liability dollar for dollar. So that's just important to know. They are very separate things, and they show up at different times in different places on your return. In this case, Paul is single, so again, his tax liability is at $6,000. However, since he is self-employed, he doesn't just pay federal income taxes. I know that's the worst part about being your own boss. He pays something called self-employment tax. And so that came out to $12,716. So you add that self-employment number to his income tax liability. So Paul owes a total of $19,000 on his 2025 tax return. So here is the last section. We've listed all your income. We'll look at the tax and the credits. And now it's time to find out how much he actually owes. So at the top here for number 25, had Paul been a W-2 employee, any of those taxes that his employer withheld from his W-2 would have been reported here. And same thing if he received any 1099s or any other income like that, and that he had taxes withheld, those taxes withheld would be reported here. However, it looks like Paul worked really close with his accountant, and his accountant did an excellent job at estimating his tax liability. So Paul actually made 4 estimated tax payments. I'll show you how those are done in the upcoming slide. That total $20,400. And so those are the only taxes that he paid into the system. And so we subtract out that $19,000 of total tax liability from this $20,000 of tax owed or tax paid, and that's how we arrive at this $818 refund figure. Lots of times when you're dealing with people who have simplistic returns, so simply just W-2s, maybe some interest statements here or there isn't really there aren't a lot of levers you can pull to get a refund. Most people take advantage of the EIC credit, the additional child tax credit, and some of those other tax credits as well to help reduce their tax liability and increase that refund. But most of the time, it really boils down to the figures in 25. Did you have enough taxes withheld to support your tax liability? If the answer is no, and you don't have any additional tax credits, then you're going to end up owing. If the answer is yes, and you over withheld, then you end up with a refund. And so that is how everything flows to the 1040. Now, I'm going to take these next couple of slides. We're going to be really diving into the Schedule C and the Schedule 1 and some of those things. But before I get started, I just want to ask real quick, does anyone have any questions about the 1040 in its entirety, how everything flows here, how we arrived at any of the figures or anything like that?
There's nothing currently in the chat, Mandy, so it looks like you can keep going. If you guys have questions, feel free to be putting them in the chat as he goes along, and we'll make sure to address them.
Sounds good. I hope no one's falling asleep here. This stuff is good. Got some fun stuff to keep learning about here. So this next form, we've talked about this quite a bit, is your Schedule 1. Again, it is titled Your Additional Income and Adjustments to Income. This is simply a supporting document. And what we're curious about here is where this $90,000 came from. Remember, this $90,000 was on the first page of the 1040. It was listed as other income, but it looks like here it says it's coming from a form Schedule C. I wonder what that is. We'll dive into that in the next couple of slides here. But this form, the Schedule 1, has two parts. Part 1 is your additional income, and Part 2 is your adjustments to your income. So some of the things here in your additions to income or additional income would be number 1, taxable refunds and credits. What that figure is if you were to itemize on your prior year tax return instead of taking the standard deduction and you received a refund from that return, that refund becomes taxable. So that gets reported here. If you took the standard deduction and got a refund, that refund that you got is not taxable. So it does not go here. So that is what that number means. Any alimony that you received, the date of divorce is very important. I believe any divorce initiated prior, any divorce or separation initiated prior to December 31st, 2017, I believe that is the date, alimony is reported as additional income. So if you waited and got a divorce in 2018, you're off the hook. But for all those who got divorced prior, alimony does get reported in Section 2A. Again, 3, it says business income or loss on the Schedule C. We'll dive into that a little bit later. 5 is interesting too, because if you have any real estate income, any royalties, if you have a K1 from a partnership or an S Corp or a trust, all of those also flow here. But as you can see from the line, there's additional schedules. So the Schedule E here, where you report all of those things. Some miscellaneous income that you'll see is gambling income, foreign earned income excluded from other tax limits, and then cancellation of debt. You have prizes and awards. So if you ever won the lottery or a prize at work that's over the limit. And then funnily enough, Olympic and Paralympic medals and USOC prize monies also get reported here. So again, any, I would say, non-normal or non-passive income that you received here gets reported on the top half of the Schedule 1. Okay, so the bottom half now, we're talking about Part 2. This is your adjustments to your income. So starting out with number 11, we have educator expenses. If you are a teacher, a coach, an educator, anything like that, you're allowed to deduct, sorry to say, only $300 in educator expenses. I know my teachers out there probably spend more than that out of pocket, but that is the limit as of right now. And that is up to $600 if you are married. For my self-employed individuals, you have 16 and 17, your self-employed retirement plans, such as SEP, Simple, and other qualified plans, as well as the self-employment health insurance deduction. So these are all things that reduce your total income. Again, these are adjustments to your income. So this will reduce your total income, which will then help to reduce your tax liability. But all of it, everything here gets reported on that front page. Now, I've told you guys to remember a couple of numbers. If you don't, it's okay. I will definitely repeat them several times. But number 15, I want to key in on here because we'll be focused on it. It says deductible part of self-employment tax, attached Schedule SE. Again, these are just more and more and more schedules and supplemental information. But what is the Schedule SE and what do they mean, deductible part of self-employment tax? Remember, Paul owed about $12,000 in self-employment tax that ended up leading to his total tax liability of 19. I'll show you where this $6,000 come from and why it's really important. And so again, we'll walk you through that Schedule SE. Again, we're accountants, we're not super creative. So SE, self-employment tax, 1099 DA, digital assets, you get the gist there. If you don't know the name of a form, you can probably guess it. And so before we move forward, again, as you can see, everything gets totaled and it gets brought down to number 26. And it says these are your adjustments to your income. And then you enter that on line 10 of your 1040. Okay, now it's time to get into the meat and potatoes here. This is your Schedule C. So this form is very important for those who are sole proprietors, single member LLCs, or essentially any non-incorporated business. What I mean by that is if you have an LLC, an LLC is considered a disregarded entity. So while you might have the naming recognition and you might be registered with the state, you're not necessarily incorporated in the sense that you don't have a separate business. In the eyes of the IRS, while they do recognize your LLC by its business name, it as its own entity is considered disregarded. What that means is the IRS looks directly through that entity and it looks directly at you. And so all of your self-employment income gets reported here on the Schedule C. I want to add a caveat to that before we move forward, that if your business is an LLC, but it is taxed as an S corporation, or you are in a partnership or anything like that, those are separate tax returns that get filed. And there's a form called a K-1 that you get from those businesses, and that gets reported elsewhere. The Schedule C is strictly for those who are sole proprietors, single member LLCs, and those sort of self-employed individuals, even if you're an Uber driver per se. If you get 1099 income, this is what we're going to focus on here. So the first part here is the name of the proprietor. In this case, again, we'll be using a special client of mine, Paul Blart. That is his name and his social at the top there. The second part is your principal business or profession and the business code in B. And so for his profession, he is a Mall of America cop, and his code 561600 is for security. So we can see here that all of that information does tie. I don't expect, no accountant expects their clients to know what code goes in box B. That is for us to know and work with you on to make sure that your business fits within those parameters. Next is your business name. Now, if you do not have a business name, meaning you did not incorporate or you did not start your LLC and establish it with the state, and you are just doing Uber or construction work or anything like that, and you're still getting 1099 income, but you just didn't formalize it in an LLC, you can leave this section blank. As we can see here, Paul does have an LLC, and for some reason he does not have an EIN number. It might be an oversight issue on his accountant, but that number gets reported in box D, his EIN or his employer identification number. Next, easy enough, is the business address. So you want this to be the location, the primary business location of your business. In this case, it looks like Mr. Paul works at Mall of America in Minneapolis. And so that's the information that we can see there. These next couple ones are pretty straightforward. Your accounting method, most people are cash. Your accounting method essentially is just based on how you are operating and how you are reporting your income and expenses. If you're cash basis, you report your income when you receive it, and you report your expenses as soon as they are paid. If you, if you are an accrual-based taxpayer or business, You're reporting income when the services are done, not when the income is paid. And you're reporting your expenses when they're accrued, not when they are paid either. So the perk of that, or the benefit of that, is if Mr. Paul here were accrual-based accounting and he reported services for, let's say, $20,000 of his mall top activities, but he was never paid that, if he took reasonable steps to claim those funds or get those funds from whoever owes those to him, and they aren't paid, he is allowed to take a deduction for bad debt. You can only do that if you're accrual, because he included that initial $20,000 in income when he did the service. Now, if he were cash basis, he would unfortunately be out of luck there. I would wish him the best in small claims court, but there is no tax benefit there because there's no income that you were reporting. So understanding your accounting method really helps you understand how you're keeping track of inventory and how you're reporting your income and expenses. The next are just a couple follow-up questions. So did you materially participate in the business? If the answer is no, there are some loss limitations there, a little bit too high level for this, and we're not necessarily going to touch on that, but again, something to consider. If the business was acquired or started in 2025, this is good to know just to make sure that we're following adequate reporting. We would hate if this business had started in 2020, for example, and he hadn't been filing for a couple of years. And then I and J essentially are just related to any payments that the business made that would require you to file a Form 1099. So if you have any contractors or anything like that, you want to put yes to I and J. Now, this is just an accounting tax prep fact. As your tax preparer, we're always going to do what's right. And so if the answer is yes, that you pay 1099 contractors, but we put no for J because you will not, or have decided to not issue those 1099s, that is a compliance red flag that the IRS will be looking out for. So just keep that in mind. You want to be accurate. You want to be as accurate as possible when it comes to filing. You want to report all your income. You want to report all your expenses, and you want to issue all the necessary documentation that's needed. So, all right there. So now we get into the income section of the Schedule C. And so here we will see that his gross receipts were about $300,000. So if you got any 1099 income, any cash, anything like that, that is what goes there in gross receipts. What income was made in the pursuit and continuation of your business is in line 1. Line 2 are returns and allowances. And so if you had any refunds or anything like that, you would put that there. And then for 3, we would just subtract the 2. In this case, that didn't apply to Paul. So his income flows down from line 1 to line 3. Next, and we'll dive into where this number comes from. I want to actually ask you to remember the 61,000 number because I've already asked you to remember 3 other figures that I hope you didn't forget. But just keep this in the back of your head. His cost of goods are $61,219, and as you can see, it says from line 42. That's the funniest part about all your taxes. You'll see all these figures, and it's like, go here to find out where that number comes from. And then you go to that form, and it's like, well, there's maybe 2 other supplementary forms you have to look out for. So this $61,000 did come from somewhere, and I'll show you where that came from briefly. So from the cost of goods, we get gross profit. This is an important calculation to know if you are self-employed or in business. Your gross income minus your cost of goods equals your gross profit. You know, gross profit and gross income are technically 2 different things, but for this case, as it's related to COGS, or cost of goods sold, we are going to just say they're the same. So we take that 300,000, we subtract out the 61, and his gross profit and gross income are now 238,781. And that's how we get that figure there. Now, what do we do with all that income? Here is part 2. This is the expense section. And so you can see there's not a lot of expenses from number 8 to 27, A or B. And that's okay. Most of these are generic and standard expenses related to your business. And if you have any business expenditures that don't necessarily fit into these categories, it is okay to put them in the other category there. Some of the main ones that I really want you all to be looking at here, we have advertising expenses, so that's pretty straightforward as the name suggests. We have some car and truck expenses, which I will take some time to explain that one, just because that one you'll see a lot of errors on and a lot of misinformation on what constitutes a business vehicle, what constitutes vehicle expenses, and those sorts of things. So we'll dive into that $8,000 number there. You don't have to remember that number, but just remember this expense. We also have line 13, depreciation, $32,000 in depreciation. I wonder what Mr. Paul wrote off there. We'll have the next couple of slides. We'll talk about depreciation, your depreciation schedule, bonus depreciation, some of those things, and how they actually flow to your return. We have insurances, office rent, some supplies, taxes and licenses, and then again, other expenses. So as you can see, there is no line 48 on this slide. So line 48 must be somewhere. And so this is yet another number that we do have to find later, later on in the form. But we essentially add up all of those expenses, and that is how we get to this $148,000 number in expenses. Now, look at that, 90,000. The number we were looking for this entire time, which is on line 10 or line 11 of the 1040. This $90,000, and the reason it was other income is because it's business profit. This is his business profit. This is his net profit here. And so we got that number from subtracting out the $200,000 figure from the income, and we subtract all your expenses here, and we get here to number 29, your tentative profit. Now, this section here, I'll just touch on briefly because there's a more detailed slide going over it, and this doesn't necessarily apply to Paul, but I just want to talk about it here. This is for your expenses of business use of your home or your home office expense. Now, there are two methods to doing this. Again, I'll talk about that in a couple of slides. There's the actual method and there's a simplified method. If you were using the simplified method, that information goes here. There is, I believe it's $30 up to 150 square feet, I believe. And that information will go here and will get subtracted from the tentative profit to get your net profit number. Again, more information on that is coming up in additional slides. I just want to point that out, that this is somewhat of a below the line type of business deduction that gets subtracted from the tentative profit as opposed to being included in the overall expenses that help us arrive at the tentative profit, if that makes sense. And so all that being said, we took the income, we took the cost of goods, we subtracted those out, we got our gross profit. We subtracted out all the expenses, and now we are left with a net profit of $90,000. And as you can see in bold here, this goes to both Schedule 1, line 3, which is where we saw that out. And it also goes to this lovely schedule, which we haven't gotten to yet, Schedule SE for self-employment tax. So before I move forward with the rest of this Schedule C, does anyone have any questions on the expenses, what can and can't be written off in the Schedule C or anything like that? Or I hope I'm not boring you all.
I don't see any questions at this time, Andy.
Okay, I'll keep going.
Yes.
Okay, so we're going to get started here. This is that cost of goods number that I was telling you about. So technically, cost of goods is typically used when you have inventory. Mr. Paul does not have inventory, but he does have other expenses that fit into this category. And so we can see that in line 37, which is his cost of labor. Now there's an important sentence after that period. Cost of labor do not include any amounts paid to yourself. This is because if you are a sole proprietor and you are reporting your income on a Schedule C, you are not permitted to pay yourself wages. When you pay yourself or take money from the business and put it in your personal, that is called a owner's draw. Owner's draws are not deductible. Do not include them as an expense. They do not count. You will still pay tax on the profit. What that means is of that $90,000 in profit, even if Paul took out $40,000 in owner's draws, he is still going to pay tax on the full 90. And that is because you are not required to take payroll. You are self-employed. Payroll only becomes a requirement in incorporated businesses such as an S corporation, for example. So just make sure you do not include any monies paid to yourself as the owner for cost of labor, even if you are paying yourself for the work you are doing related to your business. Just important caveat there. Looks like you had some materials and supplies for about $700 and some other costs as well. If there was inventory that we were dealing with, we would have an inventory at the beginning of the year and an inventory at the end of the year, and there would be a calculation here that needs to be done. However, that is not the case. So we just take the sum of these, and that's how we get to that $61,000 figure that we saw on page 1 of the income section of the Schedule C. And so that's how that flows together. Okay, now into some fun parts here. We're going to be talking about depreciation. So I'll talk about this in a couple more slides in more detail, but the maximum deduction you can take for Section 179 is $2.5 million. If you look at number 2, the cost of, it looks like Mr. Paul bought a Segway. We can see that there. His Segway was clearly less than that maximum amount of $32,000. And for number 3, what you'll see is the threshold cost. What that means is if the equipment that you purchase cost more than $4 million, which I do not think there are any Segways that cost that much money, but let's say it did. It cost $4.5 million. Every dollar that is over that $4 million starts to reduce almost dollar for dollar the Section 179 deduction that you can take. So those two numbers are very important. You get a maximum annual deduction of $2,500, but the threshold for what the equipment can cost is capped at $4 million. Anything over $4 million starts to reduce that benefit. So because both of those figures, or because the Segway figure was less than those maximums, then he was allowed to take the full depreciation amount. As we can see here, his cost was $32,500. This must be a very nice and expensive Segway, and he elected to take the full amount there. Now we'll add, as we get down to the bottom of this form here, that there are business income limitations. And so essentially what that means is you're not allowed to use the Section 179 deduction to take more depreciation than you recognize in income. So as you can see, his business income here was $122,000. And so that $32,000 was obviously less than that. And so he's allowed that full deduction. So just something to keep in mind. There's an annual cap, yet again, for the Section 179. We'll touch on that later. There's an equipment price cap, and there's business income limitations. So that's just something to keep in mind. When I started this slide, I apologize. I don't think I said the name. This is your Form 4562. This is your depreciation and amortization schedule. So this does get attached to your tax return, and it comes with this fun little listing right here. Now this form is not attached to your tax return, but it is important to review. I like to review this quarterly with my clients, and that is because we want to make sure two things. One, we treat the equipments that we use bonus depreciation in Section 179 on. We want to treat those very, very particularly. We also want to make sure that our equipment listing is accurate. Sometimes you might just sell or trade in a computer and not think about it. But if you did that, and then we get to the end of the year and you're still taking depreciation on that piece of equipment, now you're just getting a free deduction here, and that's not okay. So we want to make sure we're following this, and we're reviewing this with our accountants. It can be quarterly, it can be annually. It really just depends on the size of your depreciation schedule. I have clients that have 6 things on the depreciation schedule. Paul here has one. I have clients that have pages upon pages of the depreciation schedule. It takes me days sometimes to get through all of that. Some of the basic stuff that's listed here clearly is the asset number, the description, which is very, very important. You don't want to just be too generic and say vehicle or computer. Try to be as descriptive as you can, not only so the IRS knows that the depreciable life here is accurate based on what you are reporting, but also, again, when you're reviewing this with your accountant and you've been going to them for years, and it just says computer, but you have an office and you purchased a computer in 2020, I'm not going to remember, and you're not going to remember which computer that is. So put computer office 1 or computer office 2, or keep notes internally. Again, this page here comes with your tax return, but is not filed with your tax return. It is strictly for your internal records for you and your accountant. So just keep track of that. Lastly, here, as we can see, since we took Section 179 in the current year, we took that full amount, there is no depreciable basis anymore. We took it all. So our accumulated depreciation and our current depreciation for this year is that full amount. Very, 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 very important to know that I would tell Paul as we're sitting in our tax meeting. There is something special. It's called depreciation recapture. And what that means is you are paying back the depreciation that the IRS is allowing you to take if you are to sell or exchange property that's been deducted within its useful life. What do I mean by that? If February 2nd, 2026, there is a new Segway that comes out and he decides that he wants to trade this in, and his Segway did not really have a lot of wear and tear on it or anything like that, so they give him a trade-in value, let's say $35,000. There's a really good relationship with them. This Segway is still pretty pristine. It's 2025 edition. Well, he took $32,000 of depreciation and he sold it within 5 years. So he has to pay back the depreciation that he took, because typically what you would have done is you'd have taken this depreciation over 5 years. I would have divided this 32.5 over 5, and each year you take that. If you're taking it all up front and in year 2 you sell the Segway, well, you got to pay some of that back. That is very important to keep track of, as that can drastically change your tax outcomes if you aren't attentive to those things. Okay, we're wrapping.
Manny,
Yep.
before we move on, I see one question in the chat.
Mm-hmm.
They ask, can you deduct 1099 income paid to contractors on line 37 of Schedule C for cost of labor?
I want to go back. I'm going to go back to that slide, if that's okay.
Yes.
Was the question was, if you paid out 1099 labor, can you report it on 37?
Yes, it says, can you deduct 1099 income paid to contractors on line 37 of Schedule C for cost of labor?
Yes, you actually have 2 options of where you can put this, and it doesn't necessarily matter. And I say that with an asterisk because, again, every situation is different. This is very broad. Your cost of labor can go here. The 1099 labor income can go on line 37 of the cost of goods, but it can also go, just to go back a little bit more, it can also go on line 11, contract labor. It can go at its own expense. So you do have those 2 options as to where you want to put them. I am a nerdy accountant, so I've read the instructions where it says the instructions. So there are definitely caveats to the 2. It's really dependent on case by case, but you have 2 options on the return of where you can put those.
Thank you.
Of course. Okay, I'm going to tab back to my slide here. Sorry about that, everyone. Okay. So we're almost done. We're going to wrap this up here shortly on the forms, because I know everyone's so excited to read through tax forms with me. You can hear the excitement in my voice. I love this stuff. We have another schedule, Schedule SE. Remember, we're not creative here. SE, self-employment tax. This goes on your Form 1040. I told you guys to remember, one of the first numbers was that $90,000 here, right here. This is the net profit from your Schedule C, line 31. And we can remember that as that $90,000. Now, why is that important at all? Well, as we can see in 4A, we take that number and we multiply it by 92.35. You're asking yourself, why 92.35? Where is that number coming from? Remember, when you are self-employed, you're wearing 2 hats. the employer hat, and the employee hat. Your FICA taxes are 7.65%, hence why you often hear the term that self-employment tax is 15.3%. So with this 92.35, you're subtracting out that 7.65, your employer portion, from this calculation. And we're doing that because you actually get a deduction for the employer portion of the FICA taxes paid. And so that's where that number comes from. So all of this flows down. We have your net profit of 90. We now have our new number that we're working with, which is $83,000. So let's flow down to this next part here. Line 7, you'll see that, and I'll reiterate this in a couple other slides here, that the maximum amount of wages and self-employment earnings that are subject to the 6.2 percentage of Social Security tax is capped at $176,000, which means if you make 180, you're only paying Social Security tax on that 176. You're not paying it on the rest. Now you still pay Medicare tax on all of your income. That's a different detail for a different day. I won't bore you with that one. But it is important to note that your Social Security tax number is capped, and this number is indexed, so it does increase over the years. Very interesting thing here to note. So that's that one. So we take that limit there, that maximum deduction of 176,100, and we multiply it by 12.4, and then we multiply that same 86,000 figure from the first one by 2.9. 12.4 and 2.9, if my figures are right, that's about 15.3% self-employment tax right there. And look at that, that is where we get that $12,000 from. Remember, on the first page of the 1040, Paul's tax liability came out to about $6,000 or $8,000, but then there's this huge jump in $12,000, and this is the self-employment tax. This is where that number comes from. But if you also remember the bottom portion of Schedule 1, your adjustments, you are allowed to deduct 50% of your self-employment taxes on your return. This reduces your income. And if you think about it from a different perspective, if you were an S corporation, so you're formalized, or you're working at Walmart, a W-2, where you get a W-2 job, your employer gets a tax benefit for their portion of the self-employment, their portion of the FICA taxes that they pay for you, and you are allotted that same deduction. And the reason it's 50% is, again, you're paying 15.3%, and half of that, 7.65, is the employer hat that you are wearing, the employer portion. That number is not only reduced when it comes to the calculation of how do we get to your self-employment taxable income, that 83 figure from the line 6, but it also helps to calculate where you get this deduction from. So again, I think we've essentially touched on all of the figures I've asked you to remember, and now we can see in their entirety where they come from. Before I dive into some self-employment basics, we're moving on to the next topic. Are there any other questions? I just talked a lot. There were a lot of forms that we looked at. There's a lot more we could look at. So any other questions?
I do not see any.
Okay. So I'm just going to dive in here. Some self-employment basics. For starters, what even is self-employment tax? I've been saying that a lot. I've talked about Schedule SE and all these things. There was a lot of calculations going on, but what even is the self-employment tax? The self-employment tax essentially consists of your Social Security and Medicare taxes, again, which is primarily for self-employed individuals. Your employer will calculate the Social Security and Medicare tax for their employees, and self-employed individuals use, as we just did, Schedule SE, the self-employment tax, to calculate their self-employment tax liability. Excuse me, I need some water. The self-employment tax rate is 15.3%. So that is broken down into two key parts: 12.4% for your Social Security, as we saw on the previous screen, and the 2.9% for Medicare. For 2025, the first $176,000 of wages are subject to Social Security. Again, that is the limit. If you make anything over that amount, you are not paying Social Security, but you are still paying Medicare taxes. So that is just something to note. where we saw on the 1040 where it said additional taxes and we saw the self-employment tax. If Paul were making 180, we would see a similar line item on that schedule that says additional taxes, and that comes from the additional Medicare tax. And that is the tax on the wages over this 176 threshold number. So that's just something to know. For tax deductions for self-employed, you actually deduct 50% of your self-employment tax to figuring in your AGI. So that's your self-employment. Reduction. You also, for those who are self-employed, get a self-employment health insurance deduction. Now, I'm not talking about that in great detail. Again, these are just self-employment basics. But the way that your health insurance is paid can create a deduction for you. Whether you are a member of a partnership, a shareholder of an S Corp, or if you're just a regular self-employed individual. So that's just something to keep in mind. Your business can pay for that and get the deduction on that side, and then you get the credit on the personal return as well. So that's also very, very helpful and something to keep in mind. Quick asterisk there. I know I said I'm not getting into the weeds, but I can't stop talking about taxes for some reason. There are caveats to that deduction, meaning how it was paid, how it was underwritten, and the names and all those things are very, very, very important. So before you start doing open enrollment, please talk to your accountant if you're a self-employed individual and see if you've been missing out on the self-employment health insurance deduction. It is a very, very, very big deduction, and it can oftentimes be overlooked. So again, staying on the self-employment basics train, we're going to talk about some estimated taxes. So fun fact, our current income tax system is a pay-as-you-go tax. So you must pay the tax as you earn it or you receive income during the year. And you do that in two ways. One is withholdings. So if you're an employee, a regular W-2 employee, I should say, your employer withholds income taxes from your pay. And that tax is then paid to the IRS in your name at the end of the year, or at the beginning of the year, I should say, in January. As we're all getting our W-2s and everything right now, in box 2, that is the figure. That was the amount that was withheld on your behalf from your employer. So those are your federal tax withholdings. That's in box 2. And I want to say, I believe it's box 16. Don't quote me on that one. But it is at the bottom half of your W-2. You can also see your state withholdings as well. The second way to utilize this pay-as-you-go system is with estimated taxes. So if you don't pay taxes through withholdings, or you don't pay enough taxes, you should, and I should have just put bold here, you must make estimated tax payments. Who exactly is required to make those payments? Well, sole proprietors, partners, and S Corp shareholders, if they expect their owed tax liability of $1,000 or more when their taxes are filed. And corporations, meaning C corporations, not S corporations, C corporations, if they expect to owe any tax of $500 or more when it is filed. The rationale behind all of this is everyone else is paying as they go with their withholdings. It's what we all have to do. We all understand what it's like to get our gross check of $2,500, but then only get $1,900 deposited into our checking account. That money goes to the IRS. Everyone has to deal with those things. Because you're self-employed, you're receiving monies throughout the year, but you're not paying into the tax system. One of the hardest things to explain to self-employed individuals is, yes, your deductions that you get will reduce your business income, but in order to reduce your profit or your tax liability, I should say, you have to pay something in. Going back to the example with Paul, it looks like he worked with his accountant very closely. He paid in $20,000 and he was able to get a refund. That means that they were probably a little bit too aggressive with the estimates, but I would rather be aggressive and you get that money back, or at least be on the nose, than underpay it and then you get hit with fines and penalties and some of those things, and no one wants to deal with that. So some key dates here. When are you actually paying these estimated tax payments? So you have 4 dates, 3 in the tax year, and the 4th one is in the January of the following tax year. So we have April 15th. Yes, that is tax filing day, but that is also the date to submit your estimated tax payment, your first one. Your second estimated tax payment is due June 15th. The third is due September 15th. And the fourth and final payment is due in the following January. So please do not get scared. In January 2027, you will make your Q4 estimated tax payment for your 2026 tax year. You make 3 payments in the year, you make 1 the following. Once it becomes January 16th, though, the window is closed. If you didn't pay it and you just put it off, or you forgot, or you didn't make enough, or et cetera, expect for potential penalties and interest to be paid. It is very, very, very difficult to get those penalties waived. And why I say it's difficult is everyone gets a one-time, and this is just a little bit off track here, but every taxpayer gets a one-time penalty abatement for free, which means that if you had any penalties for not paying your estimated taxes, they're probably not going to be too high, especially if it's due January 15th. You're probably working with your accountant by then, or at least I hope so. But let's say you owe $200 as a penalty. You don't want to waste your one-time freebie on that, because what if later on you have a bigger tax liability with a bigger penalty? You want to save that. And so you want to save that one-time penalty abatement, because again, it does not recharge, it does not come back. We all get one, or the penalties just become due with the interest. So you want to make sure you're making your estimated tax payments on time, as those are very, 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 very important. Last slide here, finishing off or capping off the self-employment basics, is understanding your tax years. You have 2 options, a fiscal year and a calendar year. Now, calendar year are very, very common, and they're more simpler for tax filings because they match the IRS's timeline. Your business is closed December 31st. Your taxes are due April 15th if you're an individual, or March 15th if you are a business. I forgot to say on the previous slide, and I'll say it now since I just mentioned dates. If this date falls on the weekend, it is the preceding Monday that things are due. And so last year, I believe the business return date was March 17th instead of the 15th, because the 15th might have been a Saturday, I believe. So that's just something to keep in mind too. So the actual day of the week does play into effect. A fiscal year, on the other hand, has a definitive start and a definitive end date, while a calendar year typically runs from January 1 to December 31st. So a lot of times you'll see non-for-profits or certain construction workers, typically people who are more so in accrual-based industries, from what I have seen, be fiscal year, meaning they have a June 1st or they have a July 1st start date, and then their end of their fiscal year is June 30th of the following year. Now you can see why that would get somewhat complicated, because if you're dealing with a calendar year taxpayer and you're dealing with a fiscal year business, you have to keep track of what monies were sent out to that individual in the calendar year timeline. So what I mean by that is, if you started your year Jan 1, from Jan 1 to December 31st, you have to keep track of any filing requirements, because the person that's a calendar year filer, they need all of their tax information January, February, but your fiscal year isn't even done until June. So those dates can get kind of confusing. So you want to make sure you work with an accountant closely to see if you are a calendar year or a fiscal year, and then just try to understand that rationale of why did it do that. A really common answer is just calendar year. Again, it fits the IRS timeline. Most people work that way. It's very, very easy to set up and follow. But there are some exceptions to that rule, and there are some businesses that would benefit from a fiscal year due to the way they receive monies and due to the timing of the services that they provide. So just something to think about. Okay, any questions? I know I've talked a lot and we went over a couple of forms. There's more if you guys want to go over more, or we can just switch gears, and I'll be wrapping this up here shortly.
No questions currently, Manny, but we might need to move this presentation up earlier in the year next year.
Yeah. Okay, then let's get started here. on the last section, and we're going to be talking about deductions and or second section, sorry. We're going to talk about deductions and how to maximize your savings. So the first thing here are, or the questions I want to ask yourselves are, what are tax deductions and how they differ from credits and those sort of things. So for starter, what's a tax deduction? A tax deduction lowers your taxable income, which in turn will reduce the amount of income that is subject to taxes. So going back to an earlier example, you have a taxable income of $50,000, you claim a $1,000 deduction, your taxable income has been adjusted and reduced dollar for dollar down to $49,000. That is very, very important. That $1,000 could easily move you down into a lower tax bracket or up into a different tax bracket. So that is something to keep in mind. A tax credit, however, is different. A tax credit provides a dollar for dollar reduction in your tax liability. So for example, if you were to owe $3,000 in tax liability, but you qualify for the child tax credit, your tax liability has now reduced itself. That $3,000 tax liability minus the $2,200 in the child tax credit, you now only owe $800. So it's very important to know where these things are placed. Tax credits reduce your tax liability and how much you owe, and then tax deductions reduce your taxable income. So very different. They're represented at different times and at different places on the return. Very, very common examples, and we saw this on the 1040 of some tax credits are the child tax credit, EIC or the earned income tax credit, and the educational credits if you're paying for secondary schooling and some of those things. So lastly, how record keeping impacts deductions. I have this conversation, and every accountant probably does, and it's stressful every year, but every business owner is entitled to deduct all ordinary and necessary business expenses in your pursuit of business. An expense is not an I told you so. It's not a I think I spent $20 on this thing. You need to keep track of your expenses. Your accountant does not need all your receipts, but you need all of your receipts, at least for a 3 to 5 year range. And the reason for that is you as the taxpayer always have the burden of proof to prove that you are deducting what was actually spent. If the IRS comes and says, hey, we noticed you wrote off your home, we want to see if you actually have a home office, and you took $5,000 of deductions because you repaired the roof and all these things, and they come in your house and you just have a tiny desk in the corner, that's going to be disallowed. Record keeping really, really helps solidifies your deductions because all deductions must be substantiated. There are other things that you can absolutely put in the lap of your accountant, like your depreciation schedule, for example. It is on me to know the depreciable life of an asset. It is on me to make sure it is recorded properly. It is on me to make sure it is disposed properly. But in every single engagement letter that you'll ever sign when you do your taxes, your accountant will have some version of a census that says you are agreeing that we are preparing your return based on the information that you provided. And I think maybe those aren't going to help you. You want to make sure that you are adequately keeping good records, and this part is very, very difficult because if you think about a big company, think about Walmart, corporate. There are divisions of people whose job it is to manage expense reports and all these things. But when you're a small business owner and you're wearing the marketing hat and the business hat, and you're the employee, the employer, your head's getting heavy from all the hats that you're wearing, you almost feel like you don't have time. But you have to make it a priority. We live in a digital age. You can take a picture of your receipts. You can upload them into QuickBooks. You can dump them in a box, and at the end of the year, give that box to your accountant. He will roll his eyes. I'm rolling my eyes right now. I'm just saying it, but I would rather you have it so we can substantiate it. That is very, 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 very important. So what are some expenses that we can take? I'm going to go over a few that we looked at, that Paul used on his Schedule C, a few that he did not qualify for, And I'm going to clear up a little bit of misconceptions about a couple of these because these are the main ones that I see online, and I think there's a lot of confusion around them. So stay with me, ask any questions, cut me off at any time. So the first one is your vehicle expense. There are two separate ways to calculate your vehicle expense, and the standard mileage rate is the simplest. The IRS sets a standard mileage rate each year, which is 70 cents per mile in 2025. And you simply just multiply that rate by the number of business miles, again, business miles you drove. There are different rates for different things. So it's 70 cents per business mile driven. They have 21 cents per mile driven for medical or moving purposes for qualified active duty members of the armed forces. I know in the past, before the TCJA, you can deduct those moving expenses. That is gone. The only people that are allowed to take this 21-cent deduction on their travel mileage are for medical professionals moving. There's a caveat there. Or if you are moving for qualified active duty members of the armed forces. That is very important. Lastly, and this is often overlooked, rightfully so in some degrees, since most people do not itemize anymore, but something to consider. You get 14 cents per mile driven in service of a charitable organization. So if you are doing work for a charity and you are contributing, your time in order to make trips, let's say you're dropping off people at a shelter, or you're picking up food and taking it back and forth, you're allowed to deduct 14 cents of those miles that were used to drive for those purposes. Now, I just said this earlier, and I'm going to get really animated, but you have to keep adequate records for your mileage. Again, we live in a digital age. There are several mileage tracking apps out there. There's MileIQ, there's QuickBooks, and I'm not sponsored by any of them. Those are just the first two that came to mind. You can even go simplistic and get a notebook or a travel log, whatever works best for you. But remember, every single deduction needs to be substantiated. Quick accounting joke here. It makes me laugh when people give me their tax returns and they go, just try to find me as many deductions as you can. That's not how this works. There isn't a pot or a bag of deductions that I'm pulling out. You might qualify for the standard mileage expense, but you need to tell your accountant, and you need to have kept track of how many miles you actually drove for business. I say actually drove for business because there is an important keynote and there's a caveat, as there are to everything in taxes. When you leave your house to go to work, and when you leave work to go back home, those trips do not count. Those are commuting trips. We all have to make them. None of us get a deduction for it. There are ways around that, but you have to seek a tax professional because I cannot say that here. But again, when you are leaving and going to work, and when you are leaving work and going home, those trips do not count. You will also see this if you do any rideshare programs like Uber. Uber does not count the mileage from when you leave your house to pick up the first person. They start counting your mileage once that first person is in your car, because that first part of the trip was nothing more than the commute. I want you to do note that these rates apply to both electric and hybrid vehicles, as well as gasoline and diesel-powered vehicles. Mileage is mileage is mileage. I do not believe, because I have been asked a question in prior presentations, it applies to scooters or anything like that, but I would imagine that the tax courts definitely will eventually have someone argue that, and that'll come across their desk. But that's the standard mileage rate. The second thing you can do, and this is a little bit more difficult, but potentially can give you a higher deduction, are your actual expenses. So as the name suggests, you can deduct your actual expenses of operating your car or your truck. And so the actual use method is completely contingent on the business usage of your vehicle. So a lot of times what you'll hear online is you are, as long as you're just driving to work or you slap a logo on your car, it's a business vehicle. That is not necessarily true. If your only commute is to work and from work, then you don't have any expenses. I would rather you stick with the standard mileage rate. But let's say you have a vehicle, and it is true that your partner has their own vehicle and you use that for inner city commute, and when you're traveling to see friends and family, and your car strictly is 50% used for business, the other 50% is personal. The actual method will take that business use percentage, and then we will multiply multiply that by these actual expenses, gas, fees, insurance, depreciation, lease payments, repairs, registration. A lot of those things now become deductible, but they are only deductible if your vehicle is actually used for business purposes majority of the time. Another caveat there is depending on how you are structured, depending on how your entity is structured, meaning depending on if you're like Paul and you're a sole proprietor, or if you're an S corporation, or if you're a partnership, this deduction looks very, very differently. As we saw on the Schedule C, there was a line for the vehicle expenses, and so that's what Paul got to do. If you are an S Corp shareholder, for example, there is no place on your business return for these or the next couple of expenses I'm going to describe. However, if you're truly working from home and you're truly traveling from home, but your business is a corporation, there is a special type of reimbursement that your corp can do. Again, a little bit high level for this presentation, but that's just something to keep in mind. It's not that these deductions are lost on you because you change your entity status. It's more so that the way that you deduct them changes, and you need to make sure you're doing that appropriately. And so again, you have those two. You either do the actual or you take the standard. 70 cents per mile gets you typically a pretty larger deduction. But let's see that in action right here in this example. We have Carrie. She's a 5-star Uber driver. She's great here in town. She drove 35,000 miles in 2025 and 25,000 worth of business. She got a 1099 report from Uber and a mileage report from Uber that substantiates these 25,000 miles. I should have mentioned this in the prior slide, so I actually do want to go back here when it comes to substantiation. Go back 2 slides for here. When it comes to the standard mileage rate and substantiation for expenses, something that's really, really, really easy to keep track of is your oil changes. If you get an oil change at the beginning of the year, your mileage is listed on that sheet. And if you get an oil change at the end of the year, your mileage is going to be listed on that sheet. A lot of times what the IRS is looking for isn't just your records, but a third-party verification of that to be true. And it can be within a couple of deltas. Let's say you said that you drove 1,000 miles, but when we looked at the mileage logs, it said 1,000 miles. When we looked at the oil change reports, it said 1,020. You're not going to get in trouble for that. If it said 990, it's 10 miles. It's not a big change. But that third-party verification of your mileage is really, really important. And that's why when I'm talking about this example here with this 5-star Uber driver, Carrie, she gave me her mileage report from Uber. That is very, very, very important. That is a third-party verified source for those expenses. So Carrie wanted me to run the math. She paid extra for this. And she wants to know which deduction is the easiest. I told her it was the standard, but she just wanted to see it for herself, so we broke this down. As we can see here, I take this 25,000 and I divide it by this 35,000, which means that her actual business usage of the vehicle is about 71%. Now, this is an oversimplified version of this calculation, but if we take a look at her gas and her insurance, her oil, someone must have been tired while typing this, let's just say tires, your car wash, and your depreciation, she has about $8,000 in vehicle expenses, and she's pretty excited because she wants to write that off. But after I apply the business use percentage, she can only really deduct $5,700 of that 8. Now, if she had just listened to her accountant immediately, this $25,000 of mileage is 100% for business. I confirmed that with the Uber report. 70 cents per mile, she gets a deduction of $17,000. That's a huge, huge difference. More likely than not, the standard mileage method will produce a higher deduction for you than the total expenses, unless the car is 100% used for business, which nowadays is unlikely, and it's a very, 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 very expensive car. So as you can see, this is how that deduction is calculated. And as you can see, when it comes to intake, some of the things I would be requesting from her are not only her vehicle expenses, but her total miles driven for the year and the business use mileage of the year. Because if we were to write off everything from this 35,000 number, we're writing off we're writing off a lot of personal mileage there, and that's not okay. Any questions? Okay.
Not currently.
I don't see it.
Perfect. Okay, so now we're going to go to the home office deduction. This one is a deduction for small business owners and freelance workers who, and these two words are very, 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 very important, regularly and exclusively use part of their home for work and business-related activities. That wording comes directly from the IRS. You must have a space in your home that is used regularly and exclusively for work. Now, while there are some use cases to where you will have a desk sitting in the corner of a front room, if the front room is for family and there is no way to isolate off your desk, you will have a harder time writing that off. There are some tax preparers who will do that. I stay away from them. You want to make sure that the substantiation that is needed for the home office deduction needs to be legitimate and true. Something I always tell my clients, easiest way to get out of an audit, if they ever were to audit you for this particular reason, just a little caveat here, if you were to get audited, it's not necessarily for your entire return, it's typically something on that return that they're looking at. So let's say they said, the home office deduction looks really, really high, everything else looks fine. They would come to your home to look. Easiest way to get out of that is you have a room that is your home office and you put a separate lock on that door that your kids do not have, that you do not have, and maybe your spouse has a second spare key, and you label a sign that says office. That room is not used for play dates. It is not used by the kids. It is not used for anyone else. It is exclusively and regularly used for work. That is a legitimate home office. Remember, we have to legitimize and substantiate any and all expenses that we take. So if we were to do that and everything was fine, you're allowed to write off things like rent or your mortgage, your utilities, your real estate taxes, your repairs, maintenance, and any other related expenses. Now, this used to be very, very, very interesting. In the past, prior to the TCJA, if you took the home office deduction and you were taking depreciation on your home, when you sold your home, there was this special type of calculation you have to do to subtract out the depreciation, business usage, and all those other things, and that is now gone. If you use the home office deduction, it does not impact your ability to sell your home the way it used to, so that's really good news. Just like the vehicle expense, you have two options. The simplified method. The IRS wants to make it easy for you. They want to make it easy for me. $5 per square footage. I said not to quote me on the 150. It's 300 square feet max. That means using the simplified method, going back to, and I showed you where that would have gone on the Schedule C, a maximum deduction is allowed of $1,500. $1,500 if you use a simplified method. Yes, you could get a higher deduction, but if you want the higher deduction, you have to use the actual expense method, and this method is a bit more difficult. Your direct expenses must be like repairs to home office and those sorts of things. You take those in full. If it is 100% related to the office, if you remodeled that home office because it needed to, you needed better Wi-Fi, you want to see a fiber, all those things, that's directly related to business. Indirect expenses, though, such as your mortgage, your interest, your utilities, your real estate taxes, those are deducted based off the percentage of your home used for business. So let's say you have a 300 square feet room. I'm not going to do mental math here, but you have a 2,000 square foot house. We're going to divide those two numbers, whatever that percentage is, that's the percentage we multiply by your indirect expenses, and that's what you're allowed to deduct. The only caveat to that, just because it's on the slide, is your mortgage, interest, and your real estate taxes. If you use the actual method and you deduct a portion of your real estate taxes and your mortgage interest on your Schedule C, you have to take that entire expense and subtract it from that prorated number, and the rest can go on your return. What does that mean? It means, let's say 50% of your house is used for business, 50% is used for everyday home life. You can take 50% in this exaggerated example of your real estate taxes and put it as a deduction on your Schedule C because that goes to your home office deduction. But the state of Illinois also gives you a deduction for real estate taxes paid, but that number has to be based off the other 50%. You can't use the entire amount. Same thing if you were to itemize. If you're itemizing and you're taking that mortgage interest, you can't take the full mortgage interest and take half as a deduction. You have to make sure that you're splitting those up and allocating them accordingly. Hence why this method while the expense might be higher, the compliance risk is also high as well. Okay, the favorite one, business travel and meals. This is the easiest one that often gets misunderstood and abused, but if you travel, the trip must be for business. I repeat, the trip must be for business. It does not mean you are traveling and you are doing business. The nature of the trip must be for business. If I were to leave and go to Florida because there's a tax conference in Florida, the nature of that trip is the tax conference. Now, if I stayed 3 days later, any monies I spent past those 3 days are personal expenditures. But the main trip was for business. Now, if I went to Florida on vacation and I sent a couple of emails, worked on a couple of tax returns, did a couple of things, well, technically I was working. That doesn't count. That doesn't count. I roll my eyes every year. Everyone always tries to try it. Oh, I went on a family vacation and I worked a little bit. Doesn't count. The trip must be for business. If it is, you can deduct transportation, your rental car, baggage and shipping, any dry cleaning while you're traveling, telephone, and again, say it with me, any other ordinary and necessary expenses related to the business travel. For your meals and entertainment, there is no longer an expense allowed for activities generally considered entertainment, amusement, or recreational, unless it is a team building exercise sort of thing. So again, if you're taking everyone to the Bulls game, you're doing an amusement park, you're just having a little cheat day, it's a picnic day, those things don't count. Your meals are almost never 100% deductible. Most of the time, they are 50% deductible, and that depends on a couple of caveats. You or your employee must be present, and the food or beverages aren't considered lavish or extravagant. What do I mean by that? So if I wanted to pay for a client to come into town and I paid for their dinner, but I'm not there, that does not count. If anything, that's a gift. That's not a meal deduction. Now, if I were there and the purpose of us meeting at lunch is to not only eat because they're new to the area, but to discuss business. Not that we are talking business and we just happen to be out at lunch, but the purpose of the lunch is to talk business. Then I get to take the deduction. That's very, 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 very important. So your meal may be provided to you, a current or potential business client, a consultant, or business contact. So if you want to take me, your accountant, out to lunch, I welcome that. That's great. I forget to eat all the time. Please do. Write that off 50%. I will love to help you get that deduction. Lastly here, your club dues and membership fees. You cannot deduct these dues, including the initiation fees, for any membership in any club organized for business, pleasure, recreational, or social purpose. Club dues and membership dues are not deductible. It's a little bit different when it comes to dues and subscriptions. These are more, again, club-based, but again, you kind of get into those caveats a little bit more in detail with your accountant here. This chart comes directly from the IRS, and I think it's a fun little chart. We'll just go through it together just briefly. Were your meal and entertainment expenses reimbursed? If yes, if you were an employee, did you adequately account to your employer under an accountable plan? There's a reimbursement policy I hinted at earlier. If self-employed, did you provide the payer with adequate records? Nope, it's not deductible. If you did all that, did your expense exceed the reimbursement? Yes. For the reimbursement amount, yes, you can deduct it. For the excess amount, your meals are subject to 50% limit. Did your expenses exceed the reimbursement? No, your meals and expenses are not subject to the limit. So this is a great chart to just follow and ask yourself about the nature of your business travel and your business meals. And this simple yes or no chart will help you understand if something did or did not qualify. Well, now we're getting really into the weeds here. Some depreciation changes. We had a new tax bill go into effect last July that goes technically into effect retroactively to January of 2025. And this is called HR1, or the Big Beautiful Bill. This changed a couple of things. That's what these next slides are going to be about. The first thing we're going to talk about is bonus depreciation. Now, prior to the One Big Beautiful Bill, the bonus depreciation was set to slowly reduce. It went from 100% a couple years ago down to 80, down to 60, it's going to go down to 20, and then down to 0. But now it has been permanently, and I say that in quotation marks because anytime the government says permanent, they write that in invisible ink. That is not a political joke. That is IRS commentary. This is permanent now. So for any property that was placed in service in or after January 20th, 2025, you can utilize 100% of bonus depreciation. This applies to the immediate full cost of qualifying property in the year placed in service instead of depreciating it over many years. What does that mean and why does that matter? Well, every asset has a depreciable life as determined by the IRS. 5 to 7 years. Residential real estate, you're at 27.5 years. You're at 39 years for commercial. Everything has those limits. But for anything that has a depreciable life of 20 years or less, you are allowed 100% full expensing starting in 2025. That is very, very important. There is no dollar limit. And it's applicable to businesses at all sizes. So this is great for large corporations who have really large capital expenditures, and it's really great for small businesses who might have to buy a really, really expensive piece of equipment, and that might make them cash tight, but they get that immediate after-tax benefit because they're allowed to write it off. There's nothing worse than explaining to someone that just because you bought a $30,000, X, doesn't mean that you can deduct that full $30,000, and that's really hard to explain. It's hard to wrap your head around sometimes. I technically paid for it, but useful life is important because it matters in the sense of how long will you be utilizing said equipment in your business. If something has a useful life of 5 years, that means it's projected to last 5 years, and then you sell it afterwards, and now we're not dealing with depreciation recapture. Not to get too much in the weeds there. So just that's a very, very important to note. For qualifying property, this new permanent feature applies to most new and used tangible personal property. So personal property is essentially anything that's not affixated to the ground. So machinery, equipment, furniture, and fixing, some of those things. Some qualified improvement policy, and some of the off-the-shelf software. The reason I said personal property is because you have two types. You have personal property and you have real property. Real property, think real estate. Anything that's affixated to the ground typically has a depreciable life of over 20 years, so that does not count. So personal property does not mean you personally. It simply just means it's not affixated to the ground. You can move it even if it's a heavy piece of machinery. Real property does not count for this deduction credit because it has a depreciable life of over 20 years. Unlike the Section 179, which you saw earlier, there is no income limitation on this one, which means that if you use bonus depreciation instead of Section 179, you can actually create a net operating loss that can be carried forward on other or for future tax returns, which is good for you. So what that means is if I showed a loss already on my business, I can't use the Section 179 deduction because there's that income limitation. Whereas if I showed a loss, I can still take bonus depreciation and carry that loss forward and create that NOL for later. You can also elect out of bonus depreciation. Some might say, why would I want to elect out of this and not take the full expense? Well, that depends on conversation between you and your accountant. Let's say that you're already showing a loss. There is no purpose of electing to take this full amount in year one, when instead you can parse it out over its depreciable life. And now we have a known and consistent deduction for later years that we can mess around with and do the math on. So sometimes it's just really about doing that math to see is it worth it or not. So very, very, very important to know and pay attention to. Next here is the Section 179. We already talked about this, so I'll go over this quickly. The deduction limit has increased quite a bit. It increased from 1.22 million to 2.5, and that phase out number increased from 3.05 million to $4 million. Again, that just means that the maximum Section 179 deduction that you can get on qualifying assets in 1 year is $2.5 million. The limit to the purchases, however, the cost of the equipment, and this is really geared towards small and mid-sized businesses because most of us aren't buying equipment for $4 million. If you start buying anything over $4 million and the equipment that costs more than that, you get a dollar for dollar reduction for every dollar it is over the investment number. So just important to know. Qualifying property for Section 179, very, very similar to bonus depreciation, plus we have certain real property improvements like roofs, HVAC, security, and fire protocols. So that's just something to remember. Again, there's an income limitation. And then yes, there's an asset by asset election here. I'll move a little quickly here. I look like I'm running out of time here, so I want to make sure everyone gets as much information as they can. So here's just a quick example of how we combine these strategies. We have an asset that costs $5 million. They took the max, this client took the max Section 179 of that 2.5. And so now they have a remaining basis of 2.5 million. So again, that's that 5 million minus the max deduction claim. Well, now you can double up, go over here and use bonus depreciation for this 2.5 as well. So in the first year, you've taken 2.5 million from Section 179 and you stacked that and deducted the other 2.5 million using bonus depreciation. So now under the new current tax laws, we now can take this full $5 million deduction as opposed to having it parse it out over several years. So that's really fun. Some new things here. We have a new temporary tip deduction. So starting in tax year 2026, employees can exclude qualified tip income. What does qualified mean? In order for it to be qualified, it must be voluntary. I have to give you the tip. It must be customer driven. Credit and debit card tips counts and tips received via POS system counts. What does not qualify are mandatory service charges. Meaning, if you have a 10 or 20% mandatory service charge for any tables over 10, and that service charge is used for tip pooling, those aren't qualified tips for this deduction at least. You still have to report them, but they're not qualified. This is a temporary provision. Again, take that with a grain of salt. The TCJA was supposed to be temporary, now it's permanent. But this one is set to expire after 2028. There's a maximum exclusion of $25,000, and there are phase-out limitations as well. Your overtime deduction. This is very important for our contractors. Same thing. It's set to expire after 2028, but it is retroactive to January 1, 2025. So you get a new income tax credit for qualifying, remember that word again, overtime, that is required under the FLSA, the Fair Labor Standards Act. Very, very important to know. Only the premium portion, so the actual time and a half of overtime paid of work over 40 hours a week qualifies. And so I'll give you an example on this next slide of what that means. But any overtime that's required by the state or contractual law does not qualify. It must be FLSA mandated. There is a $12,500 deduction, and it's capped at $25,000 if you are married. And again, you can see the income limits here. This deduction is claimed on your individual 1040, and there are no requirements to itemize. You can itemize or take the standard deduction. These new deductions apply to us all evenly. So here's just a quick example here. This is standard time and a half. So Savannah earns $30 an hour and she works overtime during 2026. Her end of the year employer statement shows $9,000 in overtime pay, but since time and a half includes both regular time and overtime premium, only 1/3 of that $9,000 actually qualifies. So even though she got $9,000 in overtime pay, the deduction is only $3,000. An example 2 of double time. Charlie's employer pays a great 2x rate for overtime for certain emergency shifts. His payroll record shows $16,000 in total overtime for the year, but since it's applied at a double rate, remember we only are taking the premium rate. That's half, time and a half, not all of it. So we have to take this and divide it by 1/4, which means even though he got $16,000 of taxable overtime, he could take a deduction max of $4,000. So that is how that calculation goes. Any questions here? I'm running low on time. I have a lot of slides left, so I'm probably going to just speed through these if that's okay with everyone.
Nope, we're all good. Keep going.
Okay, so last thing here, talk about some credits that can boost your bottom line. We have 6 credits that we're going to go over. Again, I'll keep it really high level. You guys will have this presentation sent to you at the end. You can reach out if you have any questions. So first things first is a qualified opportunity zone. So this allows investors to defer federal capital gains tax by reinvesting those eligible gains into designated opportunity zones. Those gains must be invested in a fund within 180 days of realizing that gain. And the fund must invest in a qualified opportunity zone property. So that means that any eligible gains are capital gains from the sale or exchange of property, certain 1231 business property gains, and gains must be from unrelated party transactions. The QOF must also invest in qualified opportunity zone property. So this includes opportunity zone businesses, business property, or any other real estate. And lastly, and most importantly, the investment must be equity, so stock or partnership interest in equity. It cannot be debt. So you cannot take out debt or a loan to then invest into this fund. You have to actually incur the capital gains tax in order to offset it, you make an investment in this QOF, this Qualified Opportunity Fund. And so this is a nice credit that can help you reduce your taxes. Tax benefit here is this has been updated under the One Big Beautiful Bill Act. So again, this was going to sunset, but now has been permanently codified. You do have deferred gain treatment. So any gains that were invested before 2027, the original deferral rules still apply. And deferral, you can defer until the earlier of the sale or December 31st, 2026. And for gains invested in 2027, next year and after, there's a rolling 5-year deferral period that applies. And that deferral ends 5 years after the investment. There is a 10-year exclusion on here, and there have been some modernization to the maps and redesignation cycles as well. Good one here for self-employed individuals. We touched on this briefly. Is retirement plan startup costs. So you can. This is a credit that is used to encourage small business owners to offer retirement plans to their employees. So you have to be a small employer. That means that you have 100 or fewer employees who received at least $5,000 in compensation during the previous year. At least one plan must have a non-highly compensated employee to participate. Essentially, the reason for this plan is to ensure benefits are for a broad range of individuals or employees, not just those in higher paid brackets. The credit amount really is contingent on a number of employees. If you have 50 or fewer, you get 100% of eligible startup costs up to $5,000. There's also a minimum credit now of $500, even if the costs are lower than that. At a bare minimum, you're gonna get $500. If you have 51 or 100 employees, 50% of the startup costs are eligible, up to $5,000, and the minimum credit also still applies. So at a bare minimum, you walk away with $500. At most, you walk away with $5,000. And this is a dollar-for-dollar reduction, so it reduces your tax liability. Next, something that's often overused and misunderstood is the field tax credit. So to apply for this, you have to own or operate a business, and you have to meet certain requirements, such as running a farm or purchasing aviation gasoline. This credit essentially is only available for non-taxable use of gasoline, aviation gas, undyed diesel, and undyed kerosene. Non-taxable uses are purposes where the fuel isn't used on a regular driving basis. So think about a farm, off-highway business use for equipment, machines, vehicles, those sorts of things, commercial fishing, and then certain types of school or local buses as well. We have the rehabilitation credit. So this is a federal credit initiative designed to encourage the rehabilitation and preservation of historic buildings. This helps revitalize communities, preserve cultural heritage, and promote sustainable reuse of existing structures. This credit is equal to 20% of the qualifier rehabilitation expenses. So essentially, for every $100,000 you spend on rehab costs, you can reduce your taxable liability by about $20,000. This credit is claimed over a 5-year period, meaning you deduct 1/5 of that credit for each of the 5 years. We have the eligibility here and the tax benefits. I apologize, I have to keep moving forward. Lastly, we have your work opportunity tax credit. So this is used for businesses that hire individuals from certain targeted groups who face barriers to entry. So the employee must have at least 400 hours during the first year of employment. They must be certified as a member of a target group designated by a local agency. And this credit can be carried back 1 year in 20 years if not used full in the current year. So that's pretty exciting. Maybe you can use some of that unused credit in the prior year, maybe get a refund or get the money back for taxes that you paid. So the credit itself is generally 40% of up to $6,000 in wages paid. And then for certain veterans, that number increases to $9,600. And there's a resource link here to the IRS. And then lastly here, we have our FICA tip credits for employers. So essentially what this is, it is a tax credit for certain businesses, particularly those that work in the food or beverage business. And you must be in those industries where tipping is customary. So bars, restaurants, cafes, food trucks, etc. Your employees must receive tips directly from customers for servicing their food. And there is a form that you fill out to where you get a tax credit. The employer gets a tax credit for the FICA portion of tips paid for the employees. Really, the benefit here is just reduce your tax liability. So this directly reduces the business income tax liability. So that helps free up after-tax income for reinvesting in the business. And if it is not used in the current year, you can carry this credit back a year for 20 years. That is all I have for everyone. Is there any other questions?
Currently, there are not many, so we appreciate everyone who's joined today. If you guys do have questions, feel free to put them in the chat, and we'll make sure we answer them. In the remaining 5 minutes, I'm going to go through the rest of the slides here. Manny, if you want to put yourself on mute too, so we don't have that feedback, and then go ahead and navigate to the next slide. All right, so event and resources. Next. We have multiple workshops, as you guys have been attending them in our Building Blocks series. So IDOT has throughout the year done the Building Blocks series, as well as online workshops and district workshops as well. Most of you registered using the bit.ly/DBE workshop link. So you are connected already with that. Just continue to stay in tune of different workshops we're having and provide us feedback on what you guys would like to learn as well. TCTR, if you've not heard, is IDOT's annual conference. It's today's challenge, tomorrow's reward. It's going to be held this year on April 1st through the 2nd, so please save the date for that. This conference has networking opportunities as well as educational opportunities. We have breakout sessions, speakers. They provide wonderful meals and opportunities for networking. There tends to be bands and exhibitors. It's really a must attend and don't want to miss event. So again, it's April 1st through the 2nd. They also, next slide, please, have the awards that are given as well to our DBE firms of the year. They are, we have a total of 5 categories: construction, trucking, agriculture, engineering, supplier, professional. Next slide. Prime of the Primes and Roberto Orozco Memorial Award. Tanya Adams was our winner last year. Next slide, please. The TCTR recordings for our sessions, you can use that QR code to scan or go directly to the YouTube channel. But all of our 2025 sessions are out on YouTube. We will hopefully, again, have our 2026. Some of those sessions will also be recorded, but there's nothing like being at the live event. So make sure you attend. But if you do want to see kind of what you can expect for breakout sessions, you can visit the YouTube channel and watch our last year conference. This is the QR code here. Our registration is open for TCTR. So if you are interested in attending, this will be provided in the follow-up email with the presentation and links for you as well. Again, it's going to be in Springfield at the Crowne Plaza. But that's the QR code if you'd like to register. We are looking forward to having a great event and really would love to see you. You can also send in nominations if you know a DBE that should be recognized this year at our awards ceremony. We are taking nominations for those 5 categories through January 31st. You can send that email to brian.d.hendricks@illinois.gov. Don't forget those dots. But please submit your nomination if you know of someone for an individual category or all 5. If you do have supporting documentation to support that nomination, please include it. And if not, that's okay. But we do need their firm name, the award category, and the reason, at least for that nomination. And if you could send those by January 31st, that would be much appreciated. Next. So staying connected. As mentioned, right now we are in the towards the end of our building blocks series. It goes through February. Next. The January events, we have two, actually one more workshop. So this Thursday, we'll be hosting Funding Opportunities, Unlocking Capital. So if you are looking for ways to gain some capital and access to funding, please attend our Thursday workshop this month. In February, we will be hosting our categories for DOT contracting opportunities. So if your firm or some firm that you know is interested in doing work with IDOT, February at the beginning of the month, we will cover those. And then the latter part of the month will be our leveraging technology, and go back one slide, please, and innovation. So we've got some workshops and really correlated to AI, electric vehicles, drones, and how to keep your business safe with cybersecurity. So please attend our February events. In March, we will, towards the end of March, we have a pre-roadmap to prepare for TCTR. So a week before the conference, you can attend that to know exactly who our speakers are going to be, what conference breakout sessions we'll have, and just some best practices and tips to make sure you have a successful time at that conference. And then after the conference is over, we will have our award winners do a roundtable as well, where you can get to know them better and hear about how they become successful in being nominated. Eventbrite, as I mentioned, you are already registered there, but that is where we have all of our events posted for you to continue to register. And then all of our video recordings are on our next slide, are on our YouTube channel. So if you go to youtube.com at Illinois DOT, click the playlist, click right there. It'll take you to the IDOT support, next slide, IDOT supportive services channel. We do have two videos on there we didn't get to cover today. One is on the DBE supportive services program. It was in December, I believe it was the 2nd. And then we also had another workshop on the interim final rule regarding the DBE program on December 4th. So if you have not, if you're not familiar with DBE supportive services and you're not familiar with the interim final ruling with the US DOT, and you are a DBE firm, I recommend that you go to the YouTube channel and watch those two videos. They will be provided in your follow-up links as well. Next. And last but not least, this is the link for our survey. It will be in your email as well, with the presentation link and how to access the recording. As mentioned, our next workshop is January 29th, Funding Opportunities and Unlocking Capital. We appreciate you all for attending. I apologize, we went 1 minute over and did have to go a little quickly through those final slides. But if you do have questions, feel free to reach out to Manny Michelson or anyone through the supportive services department. Will be happy to help you, but you will have access to the recording and the slides as well to review them. Thank you for your time. You all enjoy the rest of your day, and we look forward to seeing you at our next workshop.